Hey, I'm Jeff Rimsberg, the editor of the Investorplace Digest and also Investing Insider, which I just recently took over from Chris Lowe. Thank you for joining us. Today, I'm really excited to sit down with veteran trader Jonathan Rose. Jonathan, thanks for joining.
Thanks for having me, Jeff. Excited to be here.
Okay, so when I describe you in the digest and what I will be describing you in Investing Insider, I talk about your time in Chicago and I mentioned that you've made about $10 million trading the market. I'm reasonably sure that our viewers would love to make $10 million in the market. So let's actually unpack that a little bit to begin. What were you doing? Were you trading stocks? Were you trading options, futures? Was it a handful of massive winners? Was it a bunch of small, consistent winners? Is it replicable? What were you doing exactly?
Sure. Well, I'm going to age myself, but I've done nothing but trade my entire career. Graduated school in '97, moved out to Chicago, and just always had kind of a dream of working on the exchanges. Just growing up, I've always loved numbers, statistics, gambling, horse racing, just factoring odds. So I first moved out to Chicago, and I was a floor trader. I traded NASDAQ futures and S&P futures on the floor of the Chicago Mercantile Exchange. And I did that for 5 years. I was one of the guys with my hands on the floor, like trading places. But that trade dried up, and it was a great trade. But what I've learned in the markets is you have to keep changing and evolving. So in 2002, the NASDAQ was getting by its lows. Volatility was really low. The Fed just started moving. I went to go trade bonds. And from bonds, I traded 2002, 2010. Fed raised rates, lower rates. The recession gave us great volatility in yield curve trading. So did that for a while. And that's when I was with a prop firm. It's actually the sixth employee. We grew it to 200 employees before selling it to a major hedge fund. And I took a year off because I needed a year off. And during that time, I trained for the Ironman. That was another kind of bucket list. Once I get my mind on something, I get really obsessed with things. So the Ironman took me 13 hours to complete, and I kind of crossed it off my bucket list, and something I'm not going to do again. But again, that's another thing off the list. And then back in Chicago during that time, my friends trading, those who were making the most money, were on the floor of the options exchange. So I'm like, heck, I had an understanding of options. I didn't have the professional level understanding of options, but I traded. So I knew enough about trading and managing money. And I went down to the options exchange and I learned a ton. And I was down there for the next 3 or 4 years, market making options. And throughout the course of that time, I made money. I made money trading, but I did have to jump around to different opportunities. Just like any other business, there are times when trades are really good, and there are times when other trades are really good. And it's important throughout my career to have evolved as a trader. So 2015, I started what is Masters in Trading. Masters in Trading started in 2015. And then in 2024, I joined Investorplace. I was actually, I've been a solopreneur or just independent trader my entire career until joining up with Investorplace. And joining up with Investorplace, when that opportunity was presented, was just an absolute no-brainer with Louis Navellier, obviously, and Eric Fry and Luke Lango. Those guys are futurists, quantitative analysts who are really, really good at what they do. And for me, it's perfectly synergistic because I'm a trader. I'm looking for opportunity. I value the markets for the here and now. Luke Lango, he's incredible. He's got a vision of what's going to happen 10 years down the line. I'm not that guy. But it's such a good mix to have somebody like that. So once that opportunity presented, I'm like, sign me up. An absolute no-brainer. So I'm thrilled to be part of the team.
Yeah, later on in this interview, I want to get into the profit surge event that you just held with those guys a few days ago. I'm going to talk all about that. But circling back to the idea of, how you kind of made your money in the market initially, it sounds like the options floor, that was the big place where it all happened.
Everything throughout my career, the big thing for me is trading is trading. I did a piece today that options and stock are the exact same thing. So trading futures, trading bonds, trading stocks, trading options, it's really all the same. I've made a bunch of money throughout my career trading everything. Options were a really good trade. The best trades for me, who I have long-term holding in my 401k and IRA, but the best trades for me are when that VIX or fear index starts poking its head up, when it gets above 18 or 20 and the market's really moving around. Those are always going to be my best years.
So it actually brings up a point I was wondering about. For a veteran trader like you, do you keep a long only portfolio that's kind of buy and hold long term and then just trade around the edges? Or how does that work?
Absolutely. Yes.
Okay.
Yes. Yes. So there's at-risk capital and there's long-term capital. So using an example of $1 million, a trader might take 200,000 of that or 150,000 of that and try to work it and try to really, really make it grow and be aggressive with that. But traders can also, if you have an IRA or a long-term book of holdings and you get a little bit bearish on the market, you could have more flexibility. You could sell upside calls on some of your holdings, just taking in some income. You can buy some downside puts for protection. It just there's so much different things you can do. And one of the mantras that I use every day with the community is the creative trader wins. You're not just a stock trader or an options trader. There are some times if you're bullish, you might want to buy a stock. But if you're bullish and a stock goes up, usually volatility is going to go down. So maybe you don't want to buy a call, because when you buy a call, you're getting long stock and getting long volatility. So maybe there's a better way to express these things. If you want to bet on a stock going down, is it going to go down with increased volatility, or will it just work its way down? Usually when stocks go down, volatility increases. Usually when stocks go up, volatility goes down. So for my world, I want to trade, I want to have long exposure. I also want to have short exposure because the markets are volatile, but we also want to be long volatility, and you get to be long volatility by owning options. You get to be short volatility by selling options, or if you're just long stock, it's really a bet on lower volatility over time.
Let's assume that we have somebody watching who's less familiar with options and how they're priced.
Yep.
In terms of the Greeks that go into it. You mentioned volatility a couple times. Just to get them up to speed, can you explain how volatility and other factors play a role in the value of an option beyond just the underlying price of the security?
Yeah. And here's just a really straightforward example to forget about Greeks. If a stock's at 10, a $12 call, it just gives you the option to be long stock from 12. That's it. Why would you want to be long stock from 12? Because if the stock's above 12, great. Your call's in the money. But if the stock doesn't get the 12 by expiration, by the time your option expires, you choose that no, you don't want to be long from 12 and your option expires worthless. So again, if a stock's at 10 and I buy the $12 call and say I buy it for $1, that's $100. It gives me the option to get long 100 shares from 12 only if that stock gets above 12. If it doesn't, well, I'll lose that $100 that I invested, that I made the play. So that difference between 12 and the 10, that's called the premium, and that's made up of time. Volatility is the likelihood that it could possibly get up there. How volatile is that name? Does it have enough like craziness to get up to 12 if it's at 10? Or is it like a slow moving turtle that's going to be like 10:01, 10:03, 10:12, and that $12 call should be worth bupkis because that turtle's not getting up there.
Mm-hmm. I
And
think I saw a
that's
good example. I'm sorry, go ahead.
no, I was just saying like just slowing things down. And yeah, the Greeks can get confusing because they're Greek letters to determine an option price. Like it just, there's too many variables that are moving around there. But if you just simplify and think of options just like stock, it seems to be a much easier way to grasp.
I think I saw an update from you recently in which this point you illustrated it with, was it the Uranium ETF, where you already owned it and then volatility spiked. So you said it's not worth it to sell a call at this point. Let's add more long exposure just through the stock. And it was a good example of how you see the difference between um, the potential profitability of the stock itself versus the option. Am I getting that right?
Yeah, no, absolutely. Because what ends up happening in that example, the stock that we're talking about is UROY, UROY, which we'll throw that out there. It is my favorite uranium stock. I love UROY for long-term investment. I actually just like the stock because the options, in my opinion, are too expensive. And so when the options are too expensive, UROY last trade might be $4. And the 7.5 calls are too expensive in that go out maybe 60 days. So that is saying that the market is pricing in a likelihood of UROY trading up to 7.5, but those options are too expensive. I'd rather just buy the stock rather than make a play that UROY's got to get up to 750 and then cover that premium. It's just a lot of movement. That's almost 100% move to get up there. So a little bit of common sense that no, I don't think it's going to move 100% in 60 days. Rather than the option, I could just buy the stock because if it moves 25%, still a heck of a return.
Mm-hmm. Now, one of the ways that you measure whether or not a stock might make the move that is on the table is through your unusual options activity tool. I'm familiar with that, but a lot of our viewers may not be. Do you mind getting into that a little bit more?
Yeah. Yes. So it's just like in stock. There's the Form 4, it's called. Like if an insider who owns 10% of the company buys shares in that company, they have to file a Form 4 within 2 days. So that says like, oh, hey, the CEO just bought 10% of stock in the company. That's something that we'd want to know. Well, in stock, there's a 2-day delay for a CEO doing a trade or a 15-day delay for an institution doing a trade. Options, on the other hand, options are completely transparent. No matter who does a trade, every single time it's shown that minute, that second that they do. So we follow that unusual option activity. It's the thought that if there's a company that's $1 billion market cap company, not like 5 trillion like Nvidia, if it's like $1 billion market cap company and there's a trade that goes down that's like a $10 million trade, well, in Nvidia that's a rounding error. Like there's thousands of those every second. But in $1 billion company, it's not often they get a $10 million option trade. So my mindset is who's ever doing that trade, they know more than I do about that company that I might have never even heard of. So I'm smart enough to know that let's jump on. They've done the work. You don't get very many opportunities as a hedge fund owner to make that kind of bet on that kind of company. He knows what he's doing. It's not 100% guaranteed, but it's real buying. That's what moves these things. More buying than selling. So when you see a big order like that, that's unusual option activity. That's what we say. Where there's smoke, there's fire. And oftentimes, you wouldn't be surprised that next week or the week after that, you see a big move in the stock because you realize that maybe the playing field's not all equal, and maybe we don't have all the same information in front of us, and people do get better information. So if we're not getting that information, good, we'll follow your orders.
Could a trader monitor this himself by just watching the the option chain on Yahoo Finance, or is there a lot more that goes into it?
Incredibly difficult. There's 5,000 different names that have options. So the software that we have is looking for the biggest trades relative to a company's market cap, and then we're showing that daily. We're breaking that out every single hour with our tool, and that's just literally from being a floor trader. These were the trades that we would sit around and wait for, and even as a floor trader, we'd have to go through all the orders. But now with technology, we break it down in real time. We get what I deem to be the most unusual trades. And that's how we've been able to have really great returns in our advanced notice service.
Nice. And does it always designate whether the option is like a put or a call, or do you have to kind of guess sometimes? I mean, what are you looking at exactly?
It's always designated whether it's a put or a call, but it's actually what has happened since 2011 is the institutions, the endowments, the people doing these massive orders are getting smarter and smarter as well. So they know that people are following those orders. So oftentimes they'll do what's called synthetic option orders, where they'll buy a whole bunch of calls, but really it's a very bearish trade, or they'll buy a whole bunch of puts, but really it's a very bullish trade. And that there's a little bit of a learning curve to learn how to figure out between the two or what it is. But that's really important. Once we see these orders, you need to definitively conclude what side of the market is. Is it bullish or it's bearish? Or maybe it's just a nothing burger. Maybe it's just like a margin trade that's not going to help us at all. So that's a very, very important component. I don't mind walking you through exactly how to do it. I'm not trying to keep any secrets.
I appreciate it. I think that's probably a level of detail that's unnecessary for our conversation today, but I see why that could be complicated.
Yeah. Let me just an overview for somebody. I'll give a quick 60-second overview.
Okay.
It's like if the two of us are sitting here making a market on something, and I'm willing to buy it for $1, you're willing to sell it for $2, and that's the market. Last trade's $1.50. I'm a buyer at $1. You're a seller at $2. Well, if somebody comes in and buys $1 million at $3, well, you just sold at $2. Whoever just sold at $3, they're moving the market. Excuse me. If someone comes and buys this product for $3 because you just sold it for $2, their $3 bid, you need to get out of it. So you're going to go $3.50 bid because you don't want it anymore. And so the market will start moving because all the market makers get caught in trades, and they don't want to get caught in trades. So if I'm $1, you're trying to sell it for $2, and somebody just buys them all for $3, you don't want it at $2. You got to chase to get out. And you can really see that in the market. That's your 60-second of how we just got run over in our order.
I have a friend who was a market maker for cotton. And years ago, when he was learning how to do it, he got stuck in some positions, and he was dangerously close to having the actual trucks with the cotton show up in front of his place for delivery because he couldn't get out of his positions. He was terrified about how that would play out.
I've traded quite a bit of cotton calendar spreads, and they're really, really volatile. Just being in the business for a while, you end up trading everything. Cotton's actually a New York product. Was he a New Yorker?
Yeah.
Yeah.
Okay, so we mentioned uranium just a moment ago. Let's switch gears to the other sort of hot corners of the market that you like right now, whether from a shorter term trading perspective or a longer term, this is going to be around for a while, confident buy and hold. You mentioned uranium, sounds like a longer term multi-year play. Walk us through what else you're looking at right now from either time frame.
I like energy plays. I like energy all over. I think when Sam Altman comes out and says, what's going to hold back AI is compute. I think that whether it's solar's got a bid under it, uranium's got a bid under it, even natural gas is strong. So right now, we've had a couple of really nice trades in natural gas, just because the cash is so freaking strong. So we're just looking for companies with natural gas exposure, companies with, all the solar companies are doing really well, and buying them on every pullback has been really nice. And the same with the uranium. So those trades, even with the market volatility, it seems that there's been a nice solid bid under those. And I'm really bullish solar. I got to tell you, I feel like the not to get political, but even taking away the subsidies, for solar to still rally in the face of all these subsidies being taken away, I think that's just really, really good strength signs for the industry.
Do you mind sharing with our viewers one or two or three specific solar names that you like?
Yeah, my pleasure. I got a check here for my little solar list. First Solar is kind of the dominant U.S. player. It's really interesting. Corning is the glass maker who does all the glass for the iPhones, is building a $1.5 billion solar plant in Michigan to take the supply chain fully into the U.S. And that is a monstrosity of a company coming in. And Corning has been performing so well. Just a really smart company as well. So I do like Corning. I like FSLR. We just had a trade, which was, pat myself on the back, kind of just clever. The thing settling between U.S. and China, getting long China solar companies as well. They got beaten up. So JKS is a Chinese solar company that we like. CSIQ is a Canadian solar company that I like as well. NXT is, I don't think they are a solar company, but more of electricity maybe. But all those, I like them all. Which one? NXT? Nextera?
Is that Nextera? I can't remember.
Got to watch us traders. We're not too familiar with the names of these companies. We are familiar with the tickers, though. Nextracker.
Okay. All right. Forget that.
NXT.
Not Nextera. Okay.
But I do
you feel reasonably strong that 12 months from now, these plays are going to be significantly higher than today.
I think so. I would be comfortable with adding to them if they went against me. So that's a pretty good sign of me being confident. A different way that we trade that most people are comfortable with, are familiar with, because I teach people how to buy options. We really don't trade with stops. Our stops are more of, we'll get in and we'll decide what we're comfortable risking before we get into a trade. And then the market's going to do what the market's going to do. We don't second guess things once we put those bets on. So that's just a little bit different approach to the market than people are used to, but it's people, I find it quite a liberating and relaxing way to play speculative trades like this, where you're not you don't need to stare at the market all day. You know what your risk is, and it works or it doesn't work.
Yeah, I think that's a big point that a lot of people who aren't familiar with options sometimes overlook. You get inundated with the message that options are risky. You'll lose your house. You'll get divorced. You'll live in a ditch. But the reality is that you can dial up or down your risk exposure to only what you're comfortable with. And rather than worry about position sizing like a long-term stock play where you need to watch how much you might drop, you can put in only what you're willing to lose like that. So it's actually a much more simple and less mind-churning way to play the market,
1,000%. And with that being said, the majority of places on the internet are going to encourage you to sell options, which is very, very dangerous. And that's where you have to be careful. But on the other side, if you're buying options where there is a fixed amount and you can have some success doing it, it's a really, really great way to trade. It's not easy. Nothing is easy. But what we're trying to do, what I've always tried to do throughout my career, and it just helps me sleep at night, is I want to risk $1 to make $5. I am not trying to risk $5 to make $1. I have zero interest in a sports game. If a team's minus 900, Like I'm not risking $900 to win $100. I'll risk 100 to make 900, but I don't care what kind of favorite you are. I'm not betting 900 to make 100. That's not how I want to make money.
Yeah. So in a moment, I want to switch to the event you had with Louis, Luke, and Eric earlier. But before we do that, big picture right now, there's plenty of chatter about the bubble, how close to the top we might be. Are you tracking that at all? Do you care? And if you do, what's your take on kind of where we are in this cycle?
I do track that. I really don't try to predict the future too much. I try to react to what's going on. One of the strongest things that I've learned and been caught by throughout my career and been forced to remind myself of is the biggest lesson that we should all be leaning on, and that's don't fight the Fed. Don't fight the Fed means if the Fed is lowering interest rates, the market's going to go higher. If the Fed's ending quantitative tightening, there's more liquidity in the system. So if we're going to go by the mantra, don't fight the Fed, I'm bullish. I'm bearish volatility. I think things are going to calm down going into the end of the year. And I think the beginning of 2026 is going to be really strong.
What would you say to the pushback that goes, okay, well, the Fed can control the short end of the yield curve, but you have the bond vigilantes who have shown that they're not happy. You look back to when the Fed started cutting rates last fall and the 10-year went up, even as the Fed funds goes down. Are we at risk of sort of a coup?
It's interesting. I don't think so. I don't think that. I think that don't fight the Fed has cost me every time in my career when I didn't follow along. And I'm speaking from experience. And I've gotten caught. And then you realize, you know what? What was the Fed doing? Just what's the bigger picture rather than getting caught up? It drives me nuts because even recently, the market pulls back because of higher AI valuations, and then the market rallies because the government shutdown's ending. We didn't fall because the government shutdown. Like everybody wants a reason of why we fall. Well, that's got to be the reason why it comes back, no? So I don't remember falling on the government shutdown, but all of a sudden we get credited for that being the rally. It's just nonsense. We've been doing this for a long time. We're sitting on our highs right now. Like if you take a step back 20 years and look at a chart, we're sitting on our highs. Now's the high? I don't think so. I mean, I would like the dollar not to lose value. I mean, I'd like inflation to stop, but market's going higher. It just continues to go higher. So I'd rather be long than short.
All right, I'm glad to hear that.
Yeah.
All right, well, let's circle back to the profit surge event from a few days ago. For people who aren't familiar with it, what exactly was it, and then why were you joined by Luke, Louie, and Eric? What's the commonality? You kind of alluded to it earlier, but let's dig more into that.
This is by far my biggest event ever. I think it was one of the biggest events for Investorplace of the year. But we opened up the service for people to join, and we're giving out like a ton of bonuses. But not only that, Louis Navalier, Luke Lango, and Eric are each sharing a trade just by coming to the event. And then what I'm also doing is in their portfolios each month, I'm looking at one of their names that are open and also sharing an options trade, either like an overlay to manage risk or a fresh trade in one of those names. So it's just a really cool way that we can all begin working with one another.
Okay. And so the general principles that we've talked about today related to how you trade options, unusual options activity, volatility. I'm assuming you dug into more of those details in the event.
It's all in the event. And then it gets people, what we have is a community, and people really say about the community, the feedback I get is like, Jonathan, it's incredible to have a voice, because I share lots of trades in there, but people can be in there and ask questions, or why, or this doesn't make sense, or this trade's garbage, Jonathan. It keeps going against us. What's going on? So it's cool that people could have a voice, but it's also a place to learn. Hopefully, just from this our discussion, education is a huge part of what I do and what I believe in. We trade a very specific way, and for people that want to learn and are curious, it's been a really cool experience. The returns are phenomenal. Our average winning trade for 2025, I think, is like 230% with a 50% win rate. So it's really, really special.
What's the ballpark duration of that trade?
I think our average hold time is maybe 40 or 45 days. We'll do quite a bit. So like right now, our portfolio, I would say, is mostly going to expire in January. My joke with December options is like eating ice cream on a 120-degree day, where it just like literally it melts while you're holding it. So I really try to encourage the team not to have exposure to December options. But right now, we're mostly January, a little bit February, 30, 60 days out.
Congrats, by the way, on having this community and the teaching that you're doing. I've seen screenshots of a lot of feedback from people who didn't know what they were doing, and now they're making some nice returns. So kudos to you. But tell me this: I've seen the returns recently, and it's legit impressive. Are we in like a good stretch for where the market is just more conducive to high returns and more frequent returns, or is something changed in your approach?
Well, I think two things. And a great question, because I've been asking myself this as well. I think two things. I think there are pockets in this market that are just crazy, whether it's quantum, uranium, solar. These names are moving so much more than the actual volatility in the market. The other thing is I've been trading for 25 years and I do research. I passed my first level of my CFA. Like, I'm looking for story-driven trades, and having the ability to research with AI, I feel like a superhero. Like, I can do so much more work and cover so much more ground. And like projects that it would take me a week to work on before, I can do in like 2 hours. So that's got to be part of it. It's just I can cover a lot more ground. And really, my ultimate goal is I love research. I love the chase, and I want a community that is helping me. And there's so much different areas of the market where somebody might find something really cool in an energy trade. Somebody else might be looking for a trade following something else. But if you get enough successful people around, it creates a big trading desk where you're in there, you're learning, people are suggesting things, and you can just cover a lot more of the overall market and have a lot more fun doing it. You're not doing it alone.
I was about to wrap up, but you just prompted more questions. And I'm assuming that our readers want to get more of your insights, or our viewers. So 2 quick questions. We mentioned energy not long ago. We talked about uranium. Why haven't fossil fuels taken off? You look at like an ETF like XOP, the energy exploration. Why is that dead in the water since June, while we have so many other energy plays going crazy?
I don't know. I wish I had more for you.
I would think that's
it's trying a little bit.
Say again.
It's certainly trying. I mean, I'm gonna share this chart with you, and maybe we can share it with everybody, and just it'll show you how I look at the market. But XOP, it's kind of a lower volatility type of stock. Can I share my screen?
Sure, please.
Let's do it. Okay, so let me just show you an XOP, and Jeff, I'm going to send you a screenshot. But XOP, it's a pretty low volatile stock. But what we look at is there's just these green and red lines, which is the expected move, which is kind of how options market makers will see prices. But XOP doesn't really get outside of that expected move too much. So it's really not very volatile. Actually, recently, it's right up to that expected move right here at 135. So if people were long, we would look that would be a place where we'd think about trimming, because with how options work, there's forced hedging that market makers are forced to do. So hopefully I'll share that with you, but it's pretty cool. And you can kind of see, like, how strong or how weak a sector is like that. So I don't know very much about the longer term direction of XOP, but just from a trade standpoint, that's how I would look at it, more of like a short term.
Yeah, it's a great way to get a beat on what's coming, just following the money flows or potential money flows.
Maybe it's because I've done this to put food on put food on the table for my family. I really need something concrete. I've studied technical analysis throughout the years, and a little bit I'll use it as a hobby, but I really won't use it to make trades. I want something that's real, that I can write down, and I have a tough time writing down a head and shoulders or a trend breakout. I want to know the CEO just invested $13 million yesterday, and I'm like, all right, buddy, I'm with this guy.
Yeah. All right, last market question, and then we'll start wrapping up. You mentioned quantum. The stuff that we've seen in quantum is unreal. We're talking multi-1,000% returns over the last year or so from a handful of these small guys. Is this going to come crashing down, and because we're way too premature right now before this becomes actually commercially viable? Or, is this the real deal where we just sort of plateau and keep going up from here as it gets more and more commercial?
I think when stocks start moving as fast as they are, like quantum, there's no really way to know where they're valued at. They just need to figure out a time or a place where they're going to start settling down and find kind of supply and demand from both sides. So I'm just looking at, say, a name like QS. QS has been flying around. Well, recently it's trying to settle down between 15 and 17. I wouldn't be surprised if vol drops on a name like that, but it still trades between 17 and 12 for a while before they come out with some real data that eventually there's got to be that proof in the pudding. They need to have that data that supports it. So that's it's gonna trade like a biotech, like a biotech. Things are going well. Things are going to go well. Then they have their PDUFA date when it's time to put their feet to the fire. And do they get approved or not get approved? So I think that's what you're going to see in quantum. I do think that governments are going to continue investing in these different names, and that's going to put a floor under these sensitive industries as well.
Volatility is probably music to your ears. I mean, that's the fuel that makes your profits,
Volatility to me just means people are having a difficult time valuing stocks. The stock market is not always right in where they value stocks, and volatility brings opportunity for us.
All right, thank you. Last question, we'll let you go. When you think back to your Chicago time, whatever period you want, you've seen a lot of markets. What is the single most memorable trade that you have had, whether that's where you made a boatload or lost a boatload? What jumps out to you?
Ticker symbol Cuba. When the U.S. and Cuba normalized relationships in 2015, ticker Cuba went from $6 to $15. Ticker Cuba is the Caribbean Basin Fund. They don't invest in Cuba at all. Zero investment in Cuba. So I had a very, very big short position in Cuba. The owner of the owner of the fund bought stock at $6 and sold it the next day at 13. So I wrote a note to the Wall Street Journal, and then we got coverage on this. And so my best trade was in 2015. Ticker symbol Cuba went from 15 down to like 3 because there's no Cuba in Cuba. There she is. Check her out. Ticker symbol
People might have
Cuba.
researched that more.
I writing media left and right, telling like, will somebody figure this out? It's the Caribbean Basin Fund. They invest in airliners. It's like the cruise liners. Like, what is it? Why are the cruise liners doubling? Like everyone's going to take cruises to Cuba?
Sometimes the market gods just hand you a gift.
Yeah, it was a closed-end fund. It's actually closed now. Cuba Fund, done. Hertzfeld.
All right. Jonathan, anything else that we haven't touched on that you'd like to mention before we wrap it up?
No, this was a lot of fun. I would encourage everybody. to learn about the community, and I say this, but I mean it from the bottom of my heart. What's going on with our community is really special. And by watching the Profit Surge event, there's a lot of community members who took their time and joined in on the event. And you'll hear directly from their words. And some of the stories are really, really just heart-wrenching. So very cool to see.
Awesome. Well, thank you for joining us, and congrats.
Awesome, Jeff. Thanks for having me.
You got it. And for you watching, thanks so much. I appreciate it. And we'll catch you next time here in Investing Insider. Thanks a lot. I'm Jeff Rinsberg.